My next guest says this 2023 legislation could similarly upend credit cards, including the rewards ecosystem.
In a recent turn of events, legislation has been brought to Congress that could destroy credit card points and rewards, taking away one of the most beloved benefits that credit card users enjoy. But could that actually be a good thing? The legislation is called the
Credit Card Competition Act.
Introduced the Credit Card Competition Act.
Credit Card Competition Act.
And the purpose is reducing credit card transaction fees for merchants. These are the interchange fees or swipe fees that you sometimes hear me talk about here on the channel. Now there's a lot of variables going on here, so let's break this down into pros and cons, and specifically how this legislation, if passed, will directly affect you. Let's jump in. So interchange fees are fees that are charged for processing transactions. These interchange fees are paid out to several different parties that are involved within each transaction. There's the bank that issued the credit card, then there's the card processing service, there's the payment network, which is most often Visa or MasterCard, sometimes Discover, sometimes American Express, then there's the bank that's receiving the payment. Who knew that paying with anything other than cash could be so complicated? Interchange fees generally make up on average about 2% of each credit card transaction. This is charged directly to the merchant. So if we buy something on Amazon, Amazon is the one that's getting charged the 2% transaction fee, not you or I. Indirectly, however, capitalism would suggest that Amazon would actually hike up their prices of their products in order to pass on that transaction fee to you so that they can maintain profit margin. Not awesome, but makes sense. The problem is this has greatly affected smaller merchants more than bigger ones, because smaller merchants have no leg for negotiation when it comes to these transaction fees. They just have to accept it. So a few years ago, I would occasionally work with realtors to help them get aerial photos for houses and properties that they were about to list. With the first couple projects, I would send an invoice to the realtor with my name, address, and total due. Then they could send me a check through good old-fashioned snail mail. Unfortunately, there's always a chance that it can be forgotten and it's overall less convenient. After that, I started to actually give them the option to pay their invoice with their card if they wanted to. It would be more convenient and I wouldn't have to worry about them forgetting or losing my check in the mail. And guess what? The realtor always chose to pay with the card, leaving me with a smaller payment because QuickBooks would take like 3% of my bill as a transaction fee. That sucks, especially for a small business. Fast forward to June of this year and Senator Dick Durbin of Illinois sponsors a bill that would, in the words of NerdWallet, require that banks of a certain size give merchants more choice when it comes to which payment network can be used for processing transactions involving their cards. They'd have to allow merchants a choice of more than one network, and per the bill, those networks cannot be affiliated with each other. So this is very interesting to me because per my capitalistic preferences, this would be very good for the market. More choice means more competition, which means lower prices within the market for you and me. I like it. But then I started hearing a ridiculous number of ads on the radio bashing this bill because it would end credit card rewards as we know it. And the number one argument against this bill is that the interchange fees that we as consumers are paying are a big factor in the credit card rewards that we as consumers enjoy. I use we very broadly because I happen to not use credit cards. And the argument against the bill goes even further. In a Bankrate article, Ted Rossman, their senior industry analyst, broke down the possible dark side of the bill, emphasizing that the bill could create more opportunity for smaller and less secure payment processing networks to be chosen by merchants, and thus creating a higher potential for credit card fraud to occur. It's another interesting take, because while losing credit card rewards like cashback is one thing, it's quite another to lose the potentially higher security that it may bring. Further on in the article, Ted also mentions that the bill could limit access to credit, because then banks would, in theory, have less incentive to offer credit cards as a product. Now, there's a lot of factors going on here, and they don't look that great for consumers on the surface. But might I argue that some of these downsides may actually be good for consumers, however, not for the reasons that Durbin introduced this bill. And here's why. The senators that sponsored this bill have the goal of reducing interchange fees so that merchants can actually lower their prices and consumers can enjoy some of the benefits of those lower prices as well. That's why he introduced a similar bill in the early 2010s to do the exact same thing for debit cards. A bunch of debit cards lost their rewards, and several studies show that regardless of the decrease in interchange fees for debit card purchases, most merchants didn't actually reduce the cost of goods. Like, honestly, I get it, because when I was doing aerial photography for realtors, if a realtor just chose to pay me in a check, I probably wouldn't have provided any sort of discount. Me providing the convenience for them to just pay the bill with their credit card was just a fee that I was gonna have to eat. But also in my defense, I didn't raise my prices when I started offering that as an option. I'm just saying this is probably not going to affect the price of goods that much if it goes through. But in my opinion, the good part of this bill potentially moving forward is this. Credit card rewards are one of the American population's favorite financial benefits. Whether it's cash back, airline miles, gift cards, whatever. But banks wouldn't offer credit cards if they weren't profitable. And man, are they profitable. Check this out from Value Penguin. It's the 2019 breakdown of banks and the amount earned directly from credit card interest. If you look at American Express, the interchange fees are a little over $4 billion and the credit card interest is over twice that. Then you've got Capital One with the credit card interest income being over $18 billion. And JP Morgan Chase takes the cake of this graphic with $51.6 billion in credit card interest in 2019. $51.6 billion, that's insane. Honestly, it's no wonder though, because according to NerdWallet, the average American household as of December 2022 has over $8,000 in revolving credit card debt. Credit cards are very profitable for banks. On top of that, an article from NerdWallet breaks down the amount of impact that credit card usage has on consumers, saying, and research confirms that people do in fact spend more money, often substantially more money, when they make purchases on a credit card instead of using cash. The reason? Delaying the pain of actually paying for a purchased item, because the bill doesn't come for another month. But compounding the problem is in fact the rewards, because every time you swipe that credit card, you're probably thinking, and I'm getting cash back. Me spending money is gonna pay for our vacation. The credit card companies found out that if they offer you a 1 to 5% discount called cash back, people are more likely to spend more, especially if people don't actually have to pay for it until the following month. And you can even keep delaying the pain by paying minimums. Again, banks offer credit card rewards because they're profitable. But what if the Credit Card Competition Act actually made credit cards less appealing? Could it in fact help the population improve their financial situations? Just a thought. This is why I like to do so many reviews about rewards debit cards here on the channel. Debit cards, though not as good as cash when it comes to controlling the psychology of spending money, are much better than credit cards because every time you have to pay for something, you must have enough money in your bank account to handle your purchase. And rewards debit cards, though maybe not as good in terms of rewards as the credit cards, can still provide even 1% cash back on your normal purchases. And I like to tell you about that because I want to inform you of other options other than credit cards, because clearly it's a problem for America. So what do you think? Do you like the idea of the Credit Card Competition Act? I'd love to hear your opinion, because on the recent poll on my channel, 23% of you would still rather have credit card rewards. If you are having problems with your own credit card debt, then let me know in the comments down below or email me. I do financial coaching and I'd love to talk to you about your situation. Now subscribe here if you'd like to see some rewards debit card reviews, and watch this video next because it's a comparison of 16 different rewards debit cards.